Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. So glad you're here. What do we got going on in the stock market today? Well, the Dow Jones is up about 100. NASDAQ's down about 20. Kind of a flat market. Not doing a whole lot yet, but it's early in the trading day. Anything can happen as we go down the road here. Now, what am I looking at? Well, you know I'm looking at that SPY. Now, SPY is trading about 358. Now, I would like to see it drop below 350 before I get in the market. So it's trading at 358 and the 20-day is trading about 370. Now it's a bottoming process. We could take off from here, but I think we've got farther down to go and the momentum is clearly to the downside. The bears are still in charge. But if we get above the 20-day, I'd probably put some money to work, but not yet. We're not above the 20-day. 20-day at 370, which is about 358, and I think it's going to drop to 350 or a little below that, and then that's where I'd like to also put some money to work. So we'll see which direction it moves here, but right now I'm kind of in a wait and see pattern. That's just what I'm doing. Of course, you have your own opinions and you got to do what you do. All right, so I want to talk today a little bit about what keeps me up at night. What I worry about. Is it a stock market crash? No, that's not what I worry about. What about the housing market coming down 50%? That's not what I worry about. I want to talk a little bit today about what I worry about and what I see is a slippery slope that the direction of our country is going on. Now, I'm kind of an older guy, but I've lived my whole life in the United States, and this was a country that was basically built on laws. We used to have laws, and they were contract laws, and they were enforced when they were broken. Now, this all went out the door during the pandemic that we had. All right, so they had this eviction moratorium. The contract between the landlord and the tenant was no longer valid, and they don't have to pay. Do you realize that there's still an eviction moratorium in some parts of California still going on the third year into this, right? So that contract law kind of has been thrown out the window because, well, they declared it an emergency, so we throw the contract out. Well, it's happening again. Now, I'm not political here. I don't know if there's any right or wrong to this, but let's say we take $500 billion and pay off the student loans for a lot of people. Once again, the student, they went into a contract. They made a contract. They were over the age of 18. They signed their name. They wanted to go to college, but now we're taking that contract. We're throwing it away. We are not basing on contract. Now, that's no big deal. It's only $500 billion. Of course, we have that extra money sitting there to pay for the student loans. Well, we're throwing the contract law out again. Now, it's kind of a slippery slope. And it's kind of dividing the country too. The social fabric of the country gets a little bit divided. Let's say you have two brothers. All right, so let's call them Leroy and Jimbo. Now, Leroy, he did not go to college. He went and worked in the construction field. Now, his brother Jimbo, he was the smart one. Jimbo went to college and Jimbo took out some loans because they didn't come from a wealthy family. But now Jimbo's out of college and he's got a higher paying job than Leroy has. Leroy's construction job does not pay what Jimbo's job does. Let's say Jimbo works in, the technology market. All right, so he's successful in the technology market. But now they both have debt. Now, Leroy, he's got his car loans. He's got credit card debt. But Jimbo, he doesn't have those car loans and credit card debt. He just has his student debt. Now, the government comes and says they're going to pay off Jimbo's student debt. Now, how are they paying that off? Well, they're paying that off with Leroy's taxes. Leroy pays taxes so that he can pay off his brother's debt. Now, his brother makes more than him. Now, so Leroy, he wants his car debt paid off. That's what he wants. And he wants to get the credit cards wiped out. Now, will we have a debt jubilee in this country? Will we have a debt jubilee? It's possible. I mean, when you think about it, the student loans are 1.5 trillion, car loans about the same, and so is the credit card loans. So you could do all this with just printing $5 trillion more dollars, and you could wipe out all the debt. Let's have this debt jubilee, so to speak, and that's possible. It's possible that we go that way. We just print the money and pay off all of the debt for the people, right? That would win a lot of votes in this coming election if they were to do that. But here's the thing. Now, what about these our country, everybody wants a bailout. Heck, I want a bailout. Why not? And we got a strong lobby as real estate brokers. We had that bailout during the pandemic. You could take your choice. You could either get the PPP money or you could get the unemployment money. What was funny about that, realtors never paid into the unemployment system. They just never did. But yet a lot of realtors collected a lot of money during the pandemic from the unemployment system. Okay, so there is a lot of bailouts in this country. And now the biggest bailout is coming. I'm telling you right now, it's coming. Okay, what is it? It's the pension funds. The pension funds are in big trouble now. We're already seeing this over in England. Anyways, the Bank of England, they have to come and they have to print all this money over there to bail out the pension funds over there. Here's what the pension funds over there were doing. They were borrowing money for the 1% and they were putting it in the bonds, at the 3%, and they were collecting the spread. But now they're borrowing, the cost of borrowing money went up for them and they're losing money because they were margin. They borrowed and they were margin. And so the Bank of England has to come in and they have to print more money so the pension funds don't blow up over there. Well, everybody's upset about this, right? Well, we say, well, in the United States, we could not possibly be that stupid. But let me tell you, we're much more stupid. We're doing a lot more dangerous things than that. The pension funds are in derivatives. They're in risky assets. Anyways, they're commercial paper. How's the commercial real estate market doing? They may not get paid back on that. They're in the car loan business. They bundle up a bunch of car loans and they buy it. They sell it to the pension funds. Now, why would the pension funds buy all this junk? Well, you see, the pension funds, they have to make about 7 to 8% on their money so that they can pay the people their money when the people retire. But these pension funds in the United States, they're in trouble. They're in trouble. Right now, they're about $7 to $8 trillion unfunded, right? Okay, so now when the pension funds get in trouble in the United States, is there going to be a bailout? Well, I would say almost 100% they're going to bail them out. Now, what are they going to bail them out with? Do we have an extra $8 trillion sitting on the sidelines waiting to bail out our pension funds? I don't think we have that money, but you know that bailout's coming when you get the pension funds for the firemen, for the teachers, for the policemen, for whatever it is. There's a lot of pension funds that are underfunded and they're in big trouble. And a lot of them are state pension funds and a lot of them in California. I think we have that CalPERS or something. 1.5 million people are on that. Now, if that's underfunded, will the government come and bail them out? Well, I think 100% that they will. And I think that's going to happen. Okay, now where are they going to get that money from? Well, of course, we're going to have to print that money because we don't really have that $7 or $8 trillion. So this money printing is never going to stop. It's just impossible to stop. Now, the Bank of England has said that. Okay, so they were raising their rates to fight the inflation. Okay, so as they raised their rates, the pension funds busted. They went until something has broken. Now, Jerome Powell, he's going to go until something breaks here in the United States. Now, will it be the pension funds or will it be a black swan coming out of nowhere? Whatever it is, it's going to result in more printing of money because that's all they know how to do. They know how to print money. That's the solution to everything. You got inflation, we're going to print money. We're going to have that Inflation Reduction Act, and it's only going to cost $1 trillion. So we'll print another $1 trillion to get rid of the inflation. It does not work that way. You see, that's what's funny. They sell you it, and that it does exactly the opposite of what that's called. The Inflation Reduction Act actually creates more inflation, but they sell it to you as a reduction act. Anyways, the United States, the way I see it, we've just been irresponsible. Now, I know the millennials, they should be really upset with the leadership that us boomers put into place. And because you're going to be the ones paying for the $7-8 trillion on this, $7-8 trillion there. Let's do a debt jubilee, another $5 trillion. So we're $31 trillion in debt right now, but that's not the problem. We have over $100 trillion of unfunded liabilities, Social Security and Medicare. Okay, now do you want to cut Social Security and Medicare benefits? Well, that's not politically, it's not politically correct, right? No politician's going to win when he comes out and says, I'm going to cut, Social Security by 30%, Medicare by 40%. You think people are going to vote for that? No, he's not going to win. He's going to get kicked out of office. So the only solution is once again to print more money. Now here's my question for you. I got a little carried away with this all. But here's my question for you. Okay, now let's say house prices are at $1 million right now, which, in my area, they're about 2 million, and other areas, maybe they're about $500,000. But wherever they are, let's just use $1 million. All right. So, okay, now let's say that they print another, 10, 20, 30 trillion more dollars, and we're down the road here. Let's call it 2 years down the road, because we've had some crises, maybe 3, 4 years down the road. I don't know how quickly this is going to happen. I just know that the solution is going to be to print more money. And when you print more money, it devalues the money. The money becomes worth less and less. It's just a fact. I mean, that's just common sense, right? Well, they'll tell you it's not, but it really is common sense. And a lot of our leaders could use some of this common sense. But when they continue to print this money, 31 trillion, and we're headed quickly to 32 trillion. You know why it's going so quick is because the higher the interest rate is, the more that it costs to pay on the debt we already have. To pay on the $31 trillion is now, 500 billion, whatever. So we're getting to 32 trillion really fast, and 33 trillion is going to be quicker, 34. But then there's the unfunded liabilities, which are over 100 trillion. So we're just going to continue to print the money, and the money's going to become worth less and less and less. So the question I have for you, if the house is at $1 million and it stays at $1 million, but we double the money that's in existence in the world by printing it, and the gallon of gas is now $15, let's call it. The value meal at McDonald's will be $25. Gold will go from about $1,700 where it is now, and let's call that up around $4,000 or $5,000. But the house stays the same. Now, did the house actually go down? That's my question for you. I get in arguments with people all the time. They'll say, no, Mike, the house did not go down. Well, I think the house went down by about 50%. Now, okay, I do believe that the houses are going to drop by 50%. In nominal terms, I believe in San Jose, California, let's say it was $1 million, it's going to be selling for $500,000 when this is all said and done, which is still 12 to 18 months down the road. But I say it's actually going to be worse than that, because the $500,000 that you purchasing power, if you sold that house, is only going to be worth about $250,000. So the house went down 50% in nominal terms, and the money you have left over goes down 50% also in purchasing power terms. Therefore, that $1 million house really will come down to $250,000. Now, a lot of people get upset when I don't talk about this with your friends. You will lose friends. They will just not like you for telling them this. But here on my channel, this is what we do. We talk about the gloom and doom, which it's really not gloom and doom, because this is reality. It's a scary movie. Halloween is this month. You could go to the scary movie, but you can just watch the news. It's plenty scary, right? Yeah, it's scary. Anyways, that's what I stay up worrying about at night. But I think that the housing market will drop 50% in nominal terms, and the money left over will lose 50% of its purchasing power due to the fact that we're going to keep bailing everybody out. We're going to keep printing money. We're going to keep printing until it all blows up, and it's going to make a big sound. When that debt bubble goes, you're going to hear it around the world, and it's not going to be pretty. Didn't mean to bum anyone out on a Wednesday. If you like this stuff, give me the thumbs up. Why not? I'm Tall Mike. Get out there, everybody. Have a great Wednesday. Bye-bye now.